The longest bear market in the S&P in decades coming to a close. As we told you, the S&P now 20% off the low from last October. Joining us now is Kevin Mahn. He is President and Chief Investment Officer of Hennion Walsh Asset Management. Is it clear sailing here, Kevin? I mean, I don't know if the market knows that we use base 10. I don't know if it knows that 20% is a round number. I don't know if any of that matters. Is this significant that it's gotten to that number, or is it still possibly just a reflex rally testing the high end, the upper end of a range that's going to continue?
Yeah, I mean, there's been a party in the stock market this year, Joe, but only 7 companies were invited. For the other 493 companies in the S&P 500 to receive their evite to the party, I think we're going to need confirmation that we're at the end of this rate hike cycle. We're going to need more comfort that any potential recessionary period is going to be relatively short and shallow. And then we'll start to see more breadth in this market recovery. Then we'll know that we're actually in a true bull market rally that has more sustainability.
Are we at the end of this rate hiking cycle?
I believe we are. My mantra is hike in May and go away. I think that last 25 basis point hike in May will be the last one of this rate hike cycle. Look, the Federal Reserve has told us essentially since March of last year that they were going to continue to raise interest rates, continue to shrink the size of their balance sheet until something broke. Well, something broke in the regional banking system. And even by their own estimates, they're forecasting GDP growth for this year to only be 0.4%. So if we did 1.3% in the first quarter, that suggests to me that there's some more difficult days ahead for the economy. The economy is slowing. They can't continue to raise rates in the face of that.
Do we have better underlying fundamentals than Europe?
I think there's more opportunities overseas. I really do.
I mean, they're in a recession.
Yes.
Does that mean one follows here, or did we do things better, do things differently? Do we have different underlying fundamentals, or are we headed there?
We're headed there, in my opinion. And that's an intended consequence of all the Fed's aggressive moves, right? They wanted to cripple demand. They did that by hurting the consumer, right? So where I look at the consumer right now, they're continuing to spend. But by the Fed's own projections, unemployment should grow to 4.5% by the end of this year. 4.5% by the end of this year. The consumer is still spending, but they're dipping more into their personal savings, putting more in their credit cards than they ever have before.
So you just said that if we do find out that that was the last hike, that could cause the market to extend its move above 4,300. So even with a recession, right? So it's going to do that even though a recession is in the cards soon.
Yes, I believe
it'll do it anyway.
If in fact we hit recessionary waters during the second half of this year, which I believe we will, that will lead the Fed to start cutting rates next year.
Next year, not
next year. Early next year. And that creates more opportunities, especially in those areas of the market that were most beat up last year, including technology, absent the 7 technology stocks that have arguably already recovered.
So in your view, the stocks that led us higher, they don't come back to join everybody else. It becomes clear that it's fine, the water's fine, and the rest will join it.
The rest should join in, specifically in the technology and healthcare sectors. We believe that's going to lead us out of this economic slowdown.
You're pretty bullish.
They always have. I think over the long term, I am bullish.
You got a year-end target for the S&P?
I don't have a year-end target for the S&P, but I do know by 2 years from now, the picture becomes a lot clearer. Rates should be lower, yields should be lower, inflation should be lower. If the Fed really does start cutting rates as aggressively as I think they will next year, well, then it's time to jump back in the water again. But you can't wait, because then you're going to miss out on the bulk of that recovery.
So we'll see new highs in all the averages?
I think by the end of 2024, we'll be hitting new highs.
But so I didn't try to get you to talk about Europe. So you think stocks over there are attractive, too? Even more attractive?
Yeah, I think the next super cycle of outperformance will be overseas. The U.S. has been in this cycle of outperformance for the last 13 years over international. Internationals trading much more attractively. They're going to keep rates higher. If we start moving rates lower, the dollar starts to get lower as well, and you could see more rallies overseas.